Hey, what's going on, everyone? Welcome to another video. Super excited to be here today. Appreciate everyone subscribing over the weekend, watching videos over the weekend. Huge appreciation. In today's video, I'm going to be talking about one specific option strategy called the call credit spread. This is definitely one you can utilize in more of a bearish market. In the video, I'll be giving two examples, one on Apple and one on Microsoft. And the reason I picked them is just because I wanted to focus on NASDAQ composite companies. So I picked the two largest from a market cap standpoint that I can go through today. If there's time, maybe I'll jump into Amazon as well and show some examples there. But that's kind of the focus of the video. If you could like and subscribe if you're not already, that'd be massive and muchly appreciated. Feel free to comment down below if you want me to cover any stocks or option strategies. Happy to do that as well. So jumping in, kind of key question, what is a call credit spread? And it's really just an option strategy that involves buying and selling options for the same asset at different strike prices. And it'll be much more clear when I jump through it with Apple, but effectively you're going to be selling a call at one specific strike price and then buying a call at a strike price slightly higher for less of a premium, and then you keep the delta of that. It'll make sense when I walk through with Apple. So jumping over here, one thing to keep in mind when looking at Apple, and honestly any stock, you have to keep in mind the earnings date. So Apple's earnings date is February 2nd, so you don't want to be in an option where the expiration is very close to that earnings date. So if it's a couple weeks past, that's fine, I mean, in my opinion. So just keep that in mind. And looking at Apple over the past, year, kind of peaked at around 178, 175, and lows around 125 and 132. So definitely this downward trend over the past year, and it's come up a little bit based off the economy and everything that's going on today. You could still say we may be in a bear market, so this is definitely a strategy you could utilize. So jumping into Robinhood, let's take a click at Trade Apple Options. So what are you going to do when you get here? There is this builder kind of button and option you can do. I'm not going to run through that today. It's great, and I'll run through that maybe in another video. But the first thing you're going to do is definitely look at the expiration. So for trading options, you want to look at an expiration that's roughly 30 days to 45 days out. So for this example, I'm going to go with February 24th. And remember, these are just examples, so definitely don't copy this. Take a look at stocks that you want to run options on, expirations, premiums that work for you and that have the right risk to reward profile for you specifically. So after choosing the expiration, the next thing we want to look at is up here. In the top left, you want to make sure you are selling a call. So we're on the calls, but we want to be selling a call. So we're going to sell a call for the first leg of the option. So if Apple's share price is about 140, then you could be a little conservative. For this example, I'll start with a 145. There is a chance if Apple continues in this upward trend, it could be above 145. So you may want to consider one a little bit more conservative. But for this example of just how it works, let's look at this. So you would sell one call, and then now you can see what happens on the right. You could see that it's currently a covered call, and it definitely mentioned this in my other videos. You do not want to sell a naked covered call. That opens up a lot of risk. As you can see, the max loss is unlimited here. So what you're going to do, it's important, is you're going to be adding a second option to this. So what you're going to do is you're going to buy a call for a leg higher. So what does a leg mean higher? It's just purely for choosing an option strike price higher than the current 145 call that we sold. So to do that, let's pick the 150. So let's buy the 150 call. So same expiration date up here, but different strike prices. So this is kind of a 5-point spread. So in my mind, it's kind of $500 at risk, $500 of collateral put towards this trade. And what's going to happen is I'm going to get a total credit today of $1.62. So one contract is 100 shares. So 100 shares times $1.62. That means I'm going to collect today $162, and I'm only putting up $500. So in theory, that's a 32% return or ROI on this type of strategy. And this may be a little bit more risky given the current stock price is about 140. So in reality, the 145 call is only 5 points away. And in a month's time from now, Apple could definitely go up that much, but it could also drop that much. So you definitely have to think about what strike price works for you and what kind of total credit you're looking to achieve. So in this example, the total credit would be 164, and it keeps changing live because it's Monday, January 23rd, the market's open. But you could see here the expected P&L in Robinhood. Now, the more conservative scenario, so I'm going to delete all of these. The more conservative scenario is maybe, let's say, I'm going to go extreme. I'm going to show you what you could do even if you go all the way to 155. So that's a buy, so definitely going to exit out of that. So like I said, check the expiration and make sure you're clicking the right buy, sell options buttons at the top. So we're going to be selling a call. So I'm going to go to the 150 and let's see what we can do here. So with 150, we would be selling a call, so showing covered call at the moment for 162. But then if we want to buy, so I'm going to go back to buy for the same expiration but a different leg. Let's go with the 152.5. This one will be interesting. So I'm going to collect $52 and I'm putting up as collateral effectively 250. The spread between 150 and 152.5. You can see down here the P&L, it's showing max loss of 195 because you're collecting 52. But I like to think about it as, 250 of collateral is being put up. We're collecting 52. So that's a 20% return in 1 month's time. You may think that's insane. That's extremely aggressive. Okay, so we can go even higher. So I'll delete this 152. Let's go to 55. So now we're selling the 150 still, we're buying the 155, so we're getting $92. I mean, this is almost 20% still. So you can kind of see the percent ROI given the different strike prices that you choose for this call credit spread. Now I want to take a look at Microsoft and walk through Microsoft as an example. And remember how I mentioned you have to take a look at the earnings date. So looking at Microsoft, on Robinhood, the earnings date is actually January 24th, which is tomorrow. So I would definitely recommend not selling an option or running an option that expires, this week. It could be extremely volatile. From my point of view, it's a little bit bearish, so I think this is a good example to run a call credit spread. So let's take a look at that. So I'm going to click on Trade Microsoft Options. Like I said before, we're going to, change the expiration date. So let's go to February 24th again. And then we want to start by selling a call. So what strike price do we want to go with? Since Microsoft's currently trading at 242, we got to figure out what strike price we want to go with. Let's be, a little conservative because earnings are coming out. So let's go with 260. Let's just see what we can do. So 260, we would collect if it was a covered call, but again, this is naked, so we definitely don't recommend this. You collect 237, so $237. But remember, we have to buy another option at a leg higher. So if we sold the 260, let's look at the 265. So if we do the 265, we would collect $80 today. So it's about a 15-ish% return. For getting $80, 79 now because it's live. 80 divided by 500, so it's roughly 15%. So depending on your risk to reward profile, this could be good for you. You may want to look at a little bit even more conservative. Let's just see what will happen if we do that. So let's go back to sell call. Let's go all the way to 270. Let's just see. So it's not going to be amazing ROI. So that's what I want to show you. So here you collect $29, but you'd be risking 500 of collateral. So it's less than 5% return, roughly a little over 5% for 1 month's time frame. Yeah, that's great in 1 month. We have to think about the kind of the risk profile of selling this type of option or running this type of option on Microsoft. So just take that in consideration. One thing I want to quickly look at is option strat. I kind of want to show you what will happen with the specific duration. So putting in Microsoft here, keeping February 24th, it's currently trading around 240. So we're going to sell one. Let's do 250, 260, and 265. So if we do this, you can kind of see what will happen each day if the stock price changes, where your option credit will be. So, today, if you exercise this option, you would collect $85 today. But every day, if the stock continued to go up, and on February 17th, you'd be down $48. So that would not be good. And you can also kind of toggle between the implied volatility, what will happen, what won't happen, if implied volatility goes up or down. So feel free to take a look at Option Strat. There's a link for it down in the description below. If you want me to cover any stocks, any strategies, and again, quick reminder, if you could like and subscribe, that'd be massive. Really helps the channel grow. Hope you enjoyed this and look forward to the next one.